So there's a rumor out there that I've heard you say a time or two that business owners, when they're starting out, should set aside 50% for taxes.
I know everybody's going to yell at me for this, and you don't need it, you don't want that. But as a general rule, the man is going to take somewhere around 50% at the end of the day, whatever's left over. The number one reason businesses fail is because they don't set aside money for tax, and they spend all their money. And when the tax man comes around, they don't have it to pay it, and they got to go on a payment plan for the next 4 years, and they're out of business because they can't afford to continue to do that. So if as a rule, if you pay yourself, you take $500 out, you put $500 in your tax savings account. You take out $1,000, you put $1,000 in your tax savings account. If you do that the whole year, when it comes time for taxes, whether it's quarterly at the end of the year, depending on your circumstances, the money's always there for the taxes. You're never going to be short. And if you're never short on your taxes, you never have to worry about that. You take that pitfall totally out of the equation. And then if we set that as the base of 50%, your CPA's job is to try to reduce that number as much as possible. And then you have a windfall of cash that you didn't know you were even going to have. So if you live on the 50% that you're making, the other 50% for tax, and at the end of the year, when we true everything up and do all the planning and the things, and that number ends up being for tax, you put away 50%, you only need 40%. Well, guess what? You just got a nice bonus.
Sounds like on April 15th, I'm going to get to go on vacation. But entrepreneurs, if you have a tax question, drop it in the comments and we'll get back to you.